WPS Medicare Audit Provider Webinar. Now, as always, the session will be recorded and we'll post the recording out to our YouTube video. So you'll be able to see that. We'll send that in the email. We'll send that link out in the email as well. And of course, we're having another session tomorrow for anybody that needs to attend that instead. So just a couple of things to start off with. As we've done for the past few webinars, we sent out the registration link ahead of time for people to register, and that way we get the username, or I'm sorry, the email address and the name of the attendee, so we can send that out. What I have in a screenshot here is kind of what we get when somebody doesn't log in and they just click the attendance link and don't give their name. It gives us this email address. Now, sometimes if the name comes through and if it's a full name, first and last, sometimes we can match it to our past rosters and tell who you are, what email address you have. Have your email address in the roster, so I see that you attended, and that'll let you know that you'll be getting a certificate in the near future. And then I'll also send out the email that has all of the recording links, the materials, all of that. You'll be able to see that as well. Let's see. We also have the, oh yeah, and just send me an email here. If you don't receive the confirmation email, but you know you attended, just send me an email and I can add you to that list. And you can just use this subject, just some generic subject like this, and that way I'll know that you were an attendee. And then after that, so I'll send that by tomorrow. And then usually after the second session, a few days after the second session, I'll get the email with actually usually a day or two after the second session, I'll send the email that has all the materials. So the agenda, the PowerPoints, the YouTube link, all of that stuff. I've got to load the recording. I've got to process the recording and load it to our YouTube channel, which takes a day or a little bit of time. But then after that, the attendance certificates will come out one by one. It'll go to every individual email address. So of course that takes a little bit longer there. Now, we have a survey, and I sent out the survey link in the email, and I certainly would appreciate if you could take a few minutes to fill out that survey. It's a pretty quick one, just giving us feedback on how the session went, if there were any new topics you'd like to see in future webinars, just things like that. But just as a reminder, that's not for MAC staff, so MAC auditors, whether it be WPS or any other MAC that might be attending, cannot take those surveys. CMS strictly prohibits that for obvious reasons there. They don't want any MAC feedback. They want provider feedback, home office feedback, things like that. And these are the survey links. You also have the QR codes here for those of you that like to use those with your phone. This is today's survey link, so that's, of course, the only one we need to worry about here. And then that's tomorrow's, which we'll show for tomorrow. So on to the agenda. We have some topics that come up all the time, some topics that we rotate, and sometimes there are brand new topics. So at the very beginning of every single agenda, I always like to have just at least a couple slides or a few slides about the S10 uncompensated care audits. This is a project that goes on throughout the year, and just give everybody an update, hit on some hot topics as reminders, things like that. We also have the Medicare and total bad debt issues. We've talked about it before, but some questions still come up, so I just wanted to make sure everybody's aware of that. A new one that we have not talked about in any webinar, it's going to become a big issue in the near future. Types are the ones that are going to be really strongly impacted by it in the near future. Then we have organ acquisition, a couple new topics related to that. And I know this only applies to a few facilities, few facility types, or relatively few facilities, let's say that. But we're going to talk about organ counts and organ revenue offsets, some things to be aware of there. And then lately I've been sticking in a miscellaneous issues topic when I send out the agenda. That way, if something comes up in the meantime between that time and when we have the webinar, I can add some topics in. And there are a few things I wanted to talk about with this topic. One of them is just about low volume, the applications. We constantly have extensions, expirations. So I wanted to give everybody a status where we are there, as well as the claims we're processing. I do want to talk about a pretty important piece of change request 13413 related to the SSI realignments, and specifically units that we had to send to CMS as opposed to using the published SSI ratio. So we'll talk more about that. I wanted to bring up just another reminder about RHC vaccines, because this one we've been getting some more questions on it, even though we've already talked about it in the past. There's a brand new topic, and I just put it in here as kind of a, I don't want to say placeholder, but I wanted to bring it up. But I also have to disclaim that we as a MAC do not have much information on this at this point either. We have the cost reporting instructions, so we'll just talk about what it is and what little information we have and what we might expect in the future. It's worksheet S12. It's related to the Medicare Advantage charge data, negotiated charge data. And then, as always, we'll talk about a quick overview of the WPS website, the webinars, all of that. So moving on to the S10 uncompensated care audits, we are about halfway through the 2026 cycle. And these audits, again, now they are pretty much an annual type of thing. And I guess by annual, I also mean they take up pretty much all of the year. They're due by December 31st of each year, with the only exceptions allowable would be if something pops up and all of a sudden now we have to do an S10 audit on it and we don't find out about it, let's say, until November. We'll see a little bit of that in just a bit. But other than that, they're due completely by December 31st. We have to HICRIS them, send it on to CMS, all of that. So we start these pretty early in the year, and we even tried to get a little bit earlier start this year than usual, sending out the letters, requesting the documentation. What we did this year that was a little bit different was we sent the letters out earlier than usual, but we gave an extra 30 days for you to submit it. Instead of just giving the 130-day time frame, we gave you basically 60 days. So the due date was technically still the same, but you were aware of it earlier than usual. The other change we made this year, which we might tweak it a little bit next year as well, but the letter actually included the name of somebody you could actually send the documentation to right away. It wasn't necessarily the same auditor that you're going to work with on the S10 audit, but it was a group of auditors worked as coordinators for this initial documentation submission. And that way you could send it to them and they would go out. Well, first of all, they'd send you the secure exchange email to kind of open up the door for communication. And then they'd go out and gather your documentation and store it for whoever ultimately gets assigned to that audit. So that was a little bit different. One of the issues we had last time was I'd send the letter out and it would basically say, hey, hold on to the information until somebody reaches out to you. But then, people wanted to send it in. So instead of waiting, they're wanting to send it in, but there was no contact to send it to. So that was the change we made this year. And again, once you, by now, you should already know who your assigned auditor is, unless there's a brand new unit. I think we have one or two new units that just popped up due to a revision to their cost report. But other than that, most of you should have your assigned auditors already. You can work with them. If anything happens to get changed, you'll be notified of that as well. Now, the piece that I wanted to stress here, and it doesn't impact everybody, but if you have an amended cost report, this could impact your S10 audit status. For example, if you did not qualify for DISH in your as submitted cost report, and now you qualify in your amended, then once we see that, you're going to be subject to the S10 audit, and we'll start the process. We'll send the letter out and all of that. Now, again, depending on when that amended cost report comes in, if it's later in the year, we may have to work with CMS to get a slight extension to be able to process it. If it comes in December 1st, it's pretty much a guarantee we're not going to get it done by December 31st. Usually takes a little longer than a month for all the back and forth with the information requests. The other thing that we're seeing more of this year is some of these cost reports are being finalized by the time we get to the S10 audit. And part of that is due to an initiative by CMS to really stress the currency of some of the cost report desk reviews. There are certain time frames for certain things now that weren't there before. And so some of these cost reports might be finalized. And again, that could, just the same as amended, that could impact your S10 audit status. If you were finalized with DISH, but you didn't have DISH initially, you'd now have to do an S10 audit. But what also could happen is if you qualified for DISH on your as submitted or maybe amended cost report, but then by the time the final cost report is settled, the new SSI ratio might not actually bring you into DISH eligibility. So that might certainly change. We might have started an S10 audit and we might terminate it midway through because you no longer qualify for DISH. CMS has stressed that it's the DISH eligibility that drives everything. If you're not eligible for DISH, or if the provider terminates completely, then there's no future impact from this rate, so we will terminate the S10 audit at that point once we find out about it. So that's just a little somewhat new information. I think we've talked briefly about the amended before. Now, the other thing that's been a little bit of a stickler for some people, and I really hope CMS changes this, but so far they've been adamant about it, the SCH providers and whether or not they are subject to the S10 audit. Now, of course, first of all, there's a difference. If the sole community hospital has a higher federal rate than a hospital-specific rate, then they're really no different than any other hospital. They're not going to be paid any extra because they were SCH, at least on the cost report. So there was never really a question about that group, but the group there was a question about was a sole community hospital that is paid on the hospital-specific rate because that happens to be higher than the federal rate. You know, the logical thought there is that why bother doing this extra review for a DISH type payment, because that extra federal payment doesn't impact their actual payment that they get. The hospital specific rate might be so much higher that any changes to DISH or UCP wouldn't impact anything anyways. And it's a logical response. It certainly makes sense why there's a concern there. But CMS has stressed that in this Federal Register back in 2021, that regardless of what the rates are, a sole community hospital, if assuming they have DISH reported, even if that DISH doesn't actually impact their payment, if they have DISH reported on ePart A, they are required to maintain the documentation and they're required to undergo the audit. And CMS, there's actually a little bit more than this. They kind of go through their explanation that sometimes things change. Maybe after a detailed review, which rate was higher might flip. That'd be rare, but it could happen. Also, there's the potential for SCH status to change, to either be terminated or whatever. So for those reasons, CMS says we still need to do the S10 audit. Keep in mind, we're doing an S10 audit that'll impact 3 future years. So CMS is basically saying across those 3 years in the future, one of these things might change. Again, hopefully CMS decides to change this and say, hey, there's such a little risk here that we're not going to do an S10 audit. But at this point, we just can't provide any exception from that. Now, the really odd part, is that if you look at the acceptability requirements for cost report submission, you're not required to submit S10 data at the time of cost report submission. You cannot be rejected for not sending S10 data when you're an SCH initially. But again, once we start the S10 audit, which in some cases is very shortly after you submit the cost report, depending on what your year is, at that point, we do need the S10 data. So just another reminder, I know we've gone through this in the S10 audit training, and I know it's frustrating. I know as an SCH, you know that it probably doesn't have any impact for you, but CMS still does require it to be done. keeping on S10 for just a few more minutes, another reminder of the new mechanism that's come into play that we have to worry about. We're trying to make sure everything's clean here for the cost report and for the listings, but it's this S10 line 25 versus line 25.01 situation. And I just briefly want to bring it up here. Let me get that cost report on. Kind of give you an illustration of what I'm talking about. So S10, line 25 and 25.01, it's right down here, and it's underneath of your main section with the charity care charges and all of that. So the line 25 and 25.01, they all relate to the number that's in line 20, column 2. So, and I don't mean it's the same number. I mean that line 25 and 25.01, if they exist, are a subset of this line 25. In other words, line 25 should include those two numbers plus probably a lot of other claims. So that's what they relate to. The placement's kind of odd. Might have made more sense to be right up underneath line 20, but regardless. So that's just what I wanted to stress here. If you have these, they need to be part of line 20, but in pretty much no situation, it'd be extremely rare for line 20 to exactly equal what is in line 25 and 25.01. That'd be a very, very rare situation. I've never seen it. So just wanted to reiterate that one more time. And then going back here, now 25 has existed for quite a while. 25.01 is a brand new line, but they do the same basic thing, just for different types of claims. They both relate to the insured claim, or the covered claim, if you will, that is partially non-covered. So when I say covered, I mean it's in the insured line or the insured column, but it's not fully covered. It's not fully insured. So some portion of that needs to be carved out and calculated separately. And that's what line 25 and 25.01 do. The difference is simply what types of claims go in there. For line 25, they're covered, but then maybe 61, 62, 63, those days are not covered. They've exceeded the length of stay limit. So this overall claim is partially covered, but partially non-covered. The non-covered, that's no longer a co-insurance or deductible. It's a charge-based item, and it has to be subject to the cost to charge ratio. And putting it on line 25 forces the system to do that, basically. Let's see. If we go down to line 25.1, it's the same basic mechanism. It's a partially covered claim because some of it needs to be subject to the cost to charge ratio. The only difference is what type of claim it's for, and it's basically for everything other than the Medicaid length of stay. So you might have exhausted benefits for some other reason. You might have services just flat out not covered. Those would be in line 25.01, and then the rest of the claim would just only be on line 20. So just a reminder of that. It's nothing, the mechanism is nothing new. It's, in my mind, it's an unfortunate mechanism. It's not the way I would have chosen to do it, but it does the trick. And I just said that it's the same number generally should not be on line 20 and 25 and 25.01. It shouldn't be the exact same number reported, because that would mean every single claim you have, it just wouldn't even be logical, because that would mean that every single claim you have is basically fully non-covered, which defeats the purpose of putting it in column 2 to begin with. So there should be a higher number in line 20, but it should include whatever's in 25 and 25.01. So we have that. And just a reminder of some of the website resources we have for S10. So these, we update them quite a bit. We have new webinars. The first webinar of every year is always focused on S10. So we have that. And I'm sure more to come next year. Oh, I do want to make one more reminder here. S10 now has part 1 and part 2 to it. we are only reviewing part 1. That's the only thing we need the documentation for. That's the entire hospital complex, all the units and everything. S10 part 2, which you do need to report, but you don't need to support at this point. You don't need to fill out a template for it. That is for just the hospital, no units. So part 2 is less than part 1. The thought is that at some point, CMS is likely going to switch over to using that, and then down the road, they'll have us audit it, but there's been no time frame set for that. And it's one of those things that because you have to start keeping the documentation, I don't think they would be out of the blue just next year. Oh, you got to start doing this. I think there will be hopefully around a year heads up on that. That's my thought on it. But again, no new information on that. So now let's talk about Medicare and total bad debts. In the past, up until, I don't know, a few years ago, when we started doing the S10 audits, I guess it's been quite a few now. But prior to that, the only thing we ever were concerned with was Medicare bad debts. Could be reported on E-Part A, E-Part B, the settlement worksheet for all of the different subunits. Medicare bad debts, they have to be obviously for Medicare patients, and they have to follow the stringent Medicare bad debt policies. Now with the S10 audits, we also start reviewing total bad debts. In other words, for all patient types, payer types, whatever, Medicare, non-Medicare, those are reported on S10 line 26 specifically. And there's the way the rules were written, still not perfect yet, but S10 line 26 is all about when that account was written off for GAAP purposes, generally accepted accounting principles. In other words, for your general ledger, regardless of any Medicare rule, because there are additional Medicare policies above and beyond GAAP. That's what it boils down to. For example, you have to wait until the Medicare bad debt is returned from the collection agency. You have the must bill policy, all of that stuff. Sometimes that'll happen after your account was written off. And in those cases, you can't write it off for Medicare purposes until that later date, but you could very well write it off for GAAP purposes early on when you met the standard accounting rules. So there's that difference in timing. One of the other confusing things that CMS has recently corrected is the erroneous use of the word expense. None of these, E-Part A, S10 line 26, none of them were ever supposed to be a bad debt expense number. That's a GAAP term, and that refers to when the expense was estimated, not when the actual write-off took place, which could be, quite a ways after that. And it could be 120 days or more after that, and it commonly is, possibly in another period altogether, and that's the timing difference here. So again, the expense is just the aggregate estimate of how many of all the patients that you had and all the dollars that were owed to the hospital might not be collected. It's not specific to a patient, but later on when the write-off occurs, that is specific to a patient, and it's that write-off that we're concerned about for cost reporting purposes. To throw another wrench into that, expense is not even the proper treatment under GAAP anymore. That's a fairly recent change. It's now a completely separate account called a implicit price concession. It's a type of contra revenue account. So on the income statement, expenses, of course, they offset revenues, but in a separate section. It's a deduction against revenue. A contra revenue account, it directly offsets revenue in the revenue section. It's like a sales discount, sales return type account. It's the same basic type of thing. For these unlikely to collect type patients or amounts, it's the implicit price concession. That's what they call it. Now, there are other contra revenue accounts that we see in hospitals, specifically a contractual allowance or contractual adjustment. And it's a different thing. Yes, they're both contra revenue accounts, but the big difference is with a contractual allowance, there was a negotiation between the hospital and the insurance company as to what would be accepted as payment rate for this particular claim, for this service. and the other amount was just flat out written off with no expectation ever of getting that money from anywhere. You can't bill it to the patient. The insurance company is certainly not going to step in and pay it later on. So it's not a bad debt. The contractual adjustment is a waived amount. It's not even the same as charity care. It's completely separate. Although charity care is also a contra revenue account. So we have three different things going on. We have a bad debt contra revenue account, the implicit price concession. We have contractual adjustment or allowance that is not allowed as a bad debt. It's a waived amount. And then we have another contra revenue account for charity care. You've offset it that way. The big difference between charity care and bad debt, well, again, with contractual allowance, it was completely waived. It didn't even get to the patient level. It didn't get billed to the patient, nothing. It was completely waived. With a charity care amount, it got to the patient level, but then a portion of it was waived because of the charity situation of the patient, the financial situation of the patient. So it was waived for that reason. That's still not a bad debt, but it's allowable as charity care. Now, to make that even more confusing, there's a very, very fine line between charity care that goes on S10, line 20, and then an indigent bad debt, indigent Medicare bad debt that goes on E Part A, E Part B, all of that. Very fine line between those two. But then the final one would be the true bad debt, the implicit price concession. There definitely was expectation of payment. There's a patient liability, but they just end up not paying it. So it's written off for that reason. So that's the key thing. All bad debts must stem from patient liabilities. And if there's a contractual allowance, that's never been a patient liability. It's removed well before that point. So that's the key thing with that. CMS has stressed this a couple times in April 4, 2019 Medlearn Matters article. They talk about that it must be, you cannot write off to a contractual allowance account. It must be at the time charged to an expense account, which is kind of misleading. The initial estimate was charged to an expense account, and then the bad debt write-off came out of the allowance account that stemmed from that expense account, if you want to get technical about it. But regardless, that was prior to the gap change. It was right around the time of the gap change, but there was no implicit price concession discussion used in this write-up. But the point here is this article was meant to be a heads up to providers that as of this date, you must comply with this. And we as a MAC have to abide by it. We cannot allow a bad debt written off to a contractual allowance account. It still comes up even all these years later, and the answer is still the same. We absolutely cannot allow that. That would be an immediate finding from CMS, and we'd have zero defense against that. We would not be following their rules. So we have the citation here, the link to that. And kind of taking it a little further to kind of support this, the IRS themselves issued a directive on contractual allowance issues in healthcare industry. Of course, we don't necessarily have to follow IRS rules. Occasionally, they'll bleed into Medicare rules for certain things, but it just supports it. It says the contractual allowance does not constitute bad debt since the provider was never entitled to collect the difference under the terms of the relevant contract. Again, there was never any expectation of collection. It was waived immediately. So that is what we have for that section. If we go to the instructions on S10 line 26, we have, we're in the after 10.1.22. So we have prior to 10.1.22 and then on or after 10.1.22. Notice the big difference here is the inclusion of the bad debts or implicit price concessions discussion that came after 10.1.22. And they have to be written off during this cost reporting period. And again, since we're talking line 26, written off is a gap term here. It doesn't have to be written off on the Medicare part of the cost report on E Part A. They might still have that account out at the collection agency, and that's fine. You could still write it off for gap purposes, and that's what determines whether it belongs on line 26. So that means for that particular year, that bad debt, let's say it is a Medicare bad debt, which is part of total bad debt, of course, it could be found on S10 line 26 and not yet be found on E-Part A, for example. Maybe next year it'll be on E-Part A because it was returned from the collection agency. It creates that kind of messy timing difference, but that's how the rules were written. Hopefully at some point everything gets kind of smoothed out there. Another thing CMS stresses all the time is that any of these bad debts, Medicare or total, need to be reported net of recoveries. So recoveries should be offset against the bad debts. And again, they're stressing that the balances must have been owed by patients to start from. So again, a contractual allowance was never owed by the patient. They didn't even get billed that amount because that was waived away before the claim was, or when the claim was processed by the insurance company. And of course, a couple other things. We can include bad debts for physicians or other professional services. Do not include amounts that are already in line 20 as charity care. And now the trick there is that some of those, we want to make sure that if you're reporting on something on line 20 as charity care, it cannot also be an indigent Medicare bad debt that you reported on E-Part A, for example. They can't go in both places. You can't get the benefit of them from both places. Yes, indigent bad debts are often called charity care bad debts. Technically, it's kind of the wrong terminology. CMS didn't really like that because it confuses it with true charity care on line 20. So we do check for duplicates across the bad debt and charity care line to make sure they're not reported twice. Or if they are, that it's only parts of a claim. One part of the claim is here, the other part of the claim is in the other place. And then, of course, if it's the obligation of the insurer, so if you have an amount that the insurer owes and for some reason is not paying, that's not a patient bad debt. That's a bad debt against the insurance company, which hopefully is pretty rare. But if that happens, you don't get reimbursed through the Medicare cost report for that in either place. So I mentioned before that the bad debt expense label was never really correct to begin with. And it's a little shrunk down here, but they used to use the word total bad debt expense in the older lines. And I know you can't see it, it's probably blocked, but now they're using the term total bad debt amount. So they've genericized that term. That's fine, that's better. The instructions were always correct. They always talked about it needing to be a write-off, but it was always a kind of a pet peeve of mine that they use that term expense here to begin with. So we're still in Medicare and total bad debts. This is one that has several issues, even more than what we're going to cover today. But one of the other things that pops up still to this day, even after the 2021 Federal Register, is that if it's an indigent bad debt, and now we're talking Medicare bad debt on E-Part A, E-Part B, if you've written it off due to indigence, then there must be documentation to show that the asset test and the income test were reviewed, or there was an asset test and income test as part of the indigence determination. The one that is usually the biggest thing is the asset test. The income test is pretty easy to come by, so that's very seldom left out. But the asset test, for multiple reasons, is often left out or has been left out. There were a lot of court cases, and they've codified the rule into the Federal Register now. So yes, the whole should versus must, that was part of the appeal. Why did CMS use the word should if they meant must? But in any case, the rule for all years, prior and prospectively, after, on or before or after this final rule, is that there must be an asset test as well as an income test. And you can't rely solely on presumptive indigence. You could certainly have presumptive tests done in addition to the asset and income tests. You could also look at their credit score. You could also look at some other third-party determination, but you can't eliminate the income and asset tests that, as a provider, you must do. So that's been a big issue. It still comes up. And down here in red, I know that's kind of blocked there. CMS said, finally, we have reviewed the federal court decision cited in some comments, and CMS does not agree that they prevent us from adopting these rules regarding these total resources, income, and assets. So plenty of commenters brought up the court cases, and CMS still stuck to their guns, and they codified this. It now has the power of regulation. It doesn't mean it won't be appealed further, but now there's stronger authority behind it. So the difference here, just a slight difference, is how strong the policy is, or how strong the rule is, I should say. Prior to 10.120, it was in policy only because the regulation itself, wasn't enforced at that time. But 10.120 and after, it's both in policy and regulation. The one thing that's different is that in 2021, or for 10.120 and after, they removed the other two requirements for liability and expense testing. That's no longer a requirement. It certainly behooves a provider to look at them during their review, but it's not a requirement. There's no risk to Medicare, to the program, if a provider does or does not review liabilities and expense. But there is a risk if they don't review assets and income. And of course, that risk is that more patients might be deemed indigent than otherwise should be. So when a patient is deemed indigent, then that exempts them from the normal collection effort of Section 310 of the policy. So Section 312 deals with indigents, deals with all the rules of indigents, including the Medicaid side of that, how they're automatically deemed indigent due to being Medicaid. The topic we're talking about now is all about a timely determination of indigence. This is one thing I wish CMS would have clarified in the final rule, but they left out. So we're left with just policy now on the timing of indigence. If you take a look at Section 312, which is the only authority there is for indigence itself for the timing, it says in some cases the provider may have established before discharge or within a reasonable time before the current admission. Now, before discharge means that the patient's in there, they've got their documentation, and after a couple days, they've determined them to be indigent. And it's before discharge. So that makes perfect sense. This within a reasonable time before the current admission, that basically means they're piggybacking off of a prior claim and indigence determination at that point. Now, obviously, it has to be a reasonable time. If this was 10 years ago where they were deemed indigent, you wouldn't be able to piggyback off of that. But if it was just 6 months ago, for example, not enough time might have passed for there to be any change in their financial situation. So there's the timing rules. It doesn't really technically allow you to make a determination after discharge, but it also stops short of very clearly saying this will be not allowed. And historically, it's been allowed within reason. And that reason, and CMS has actually stressed this to max in some of our rules now, the way they've ordered some of our desk review steps, that if that indigence determination is not made within a reasonable time, we'll define reasonable time here in a bit, the standard collection effort should be applied until the indigence determination is made. So the reasonable time is basically the timely billing requirement. So by whatever time you would have normally had to send the bill out, and that was based on when the RA came in, 120 days after the latest RA, if you have not made the indigence determination at that point, then you do need to start treating it like a standard non-indigent patient and bill them until you've deemed them to be indigent. So we put together a little article kind of summarizing that here, but this is one of those topics that is coming up. It's fairly new as far as the how it's become a hot topic. We've seen it more, and there's pushback on it from CMS when we do this. And again, as I said, some of our review steps have changed to really stress this. So that's what I wanted to mention there. So basically, the earlier you can make the indigence determination, the better. That is about all I had for the Medicare and total bad debts. So now I think we'll switch over to a brand new topic that we haven't covered in any webinar. Any sort of unit that could normally operate as a freestanding unit, but instead decides to be integrated with the hospital in many different ways. This provider-based attestation we're going to talk about, it's all about proving multiple levels of integration with the hospital. By the way, this 42 CFR 41365, this is the regulation that's been around for 24 years now, and it drives everything. It has all the details. However, I'm going to say right up front that I do believe CMS is going to be issuing a proposed rule at some time in the future to revise that regulation for a lot of the things we're going to talk about today. On that same note, though, we don't know exactly what the changes are going to be. It's possible they might make this a less intensive process than it currently is. It's possible they might change some of the interim term deadlines. So we don't know for sure, but we can go through what it basically is and give some background on it and then what we think might happen. So one of these provider-based units, when they file as a provider-based unit, they report under the hospital cost report as opposed to having their own freestanding cost report. For example, a provider-based RHC versus a freestanding RHC. The freestanding RHC would have to file its own little cost report. If you had a freestanding SNF, obviously it'd file its own cost report. But anytime they're provider-based, they're rolled up under the umbrella of the hospital. Now, depending on the type of provider or type of subunit, for example, we're looking at, they might be built under a different mechanism. They commonly are. Certainly these outpatient ones we're talking about, they, as a freestanding, they'd likely be subject to the standard fee schedule, the physician fee schedule. When they're provider-based, they may be billed under OPPS, and there are likely payment differences. A lot of times, although not every single time, but a lot of times this might lead to higher payments. So, of course, the program is paying out more for essentially the same service. So that's always a concern of CMS. They want to make sure it's legitimate if that's the case. But possibly even a bigger concern is CMS wants to watch out for the patient as well. When you have a provider-based unit, there are basically going to be two claims sent to that patient, or two bills sent to that patient. One is from the provider-based facility and one's from the hospital overall. So they may end up with two co-payments or two sets of co-insurance for the claim. And now the benefit for everybody is potential administrative efficiency. Again, you don't have to file separate cost reports. They're under one cost report. They have one desk review, all of that. And you on your side with the accounting records, it might be more efficient to do it that way. So there are basically pros and cons of provider-based units on all sides of the scenario. And it's been that way for a long time. CMS just wants to make sure that when a unit's determined to be provider-based, it is legitimately integrated with the hospital. So we're requiring proof of true integration with the hospital. Now, the thing about this is when the rule first came out back in 10-1 of 2002, the underlying adherence to the regulation was required. In other words, you had to meet all those integration requirements, but what you didn't have to do every time was fill out a submission or an attestation and submit all the documentation to prove it. It's not like there was a desk review done on every single provider-based unit for this issue. It wasn't a mandatory review at the time. So it was voluntary. And I'll show you the benefit of doing it at the time, but now that's all changing for many of the units, not all the units, but a certain subset of units. So again, you always had to adhere to the regulation and meet the underlying requirements of integration. And if CMS, let's say you did not submit the attestation and somehow CMS or the MAC came across a unit that was truly not integrated, what that would have led to would be the recoupment of all the extra money you received as far back as they could recoup. So that was actually one of the benefits of being proactive in submitting the attestation. Let's see, do I have a slide here? Well, I'll just mention it. The benefit was that if you do submit an attestation, if you voluntarily submitted it, that basically reduced how far back CMS could go to recoup funds if they later found it to be improper. Let's say you submit the documentation and we find out, well, you're not quite fully integrated, so this has to stop. CMS would not be able to go back prior to the attestation submit date. So it limited your loss, your potential loss, and it helped you to assure that you were meeting the requirements properly. Now, there was a change that was made between 10/1/2002 and now, and this happened around 11/2 of 2015. Certain off-campus departments, if they were not already established, they were not already grandfathered, if they came about after 11/2 and they weren't in process or anything until after 11/2 of 2015, then they're now paid under the fee schedule instead of OPPS. So they're basically paid the same that they would have been as freestanding. So there was really no monetary incentive to improperly file as provider-based. Now, for this reason, the attestations dropped significantly. I mean, very, very significantly compared to what the number we used to have before. Again, there's no payment difference. And by the way, one of the rules in the regulation, which we'll look at here, I think we'll have time, basically said that if your particular provider type or your subunit type, department type, whatever, if there is no difference in payment, then don't even bother submitting an attestation, because again, what's the incentive? Audits and reviews are all about risk, and if there's no risk, there's no underlying risk, then why would we do the review? That was basically CMS's stance. But the new change from the Consolidated Appropriations Act of 2026, by the way, it's limited to off-campus outpatient departments. So just that subset, anything that's on campus or anything that's not an outpatient department wouldn't be subject to this. But it mandates that those particular provider-based units have a provider-based attestation submitted, a new one, by the way. Even if you submitted it in the past, CMS was very clear that it has to be done again. And furthermore, you now have to obtain a separate NPI, National Provider Identifier, and bill under that NPI, which, if you think about it, that kind of pulls a little bit away from the integration, because now that they're separate, again, that kind of pulls just slightly away from the integration, but that's just the way it is in this case. And CMS mandated that because they want to see what claims are coming in. That's kind of what it boils down to. And let's see here. So this is due by 1/1 of 28, so there's still a little bit of time, but there's obviously several different units. And let's see. So failure to submit the attestation will result in a loss of the OPPS payment. And the other thing is, they haven't worked out all the details yet, but it's not just a one-time attestation. The first attestation is due by January 1st of 2028, and then however long it takes to review after that. But there's also going to be a schedule that they publish that maybe they're going to require it every 2 years, 3 years, 5 years, who knows what it'll be, but they are going to be requiring an updated attestation every so often. So as you can imagine, that's going to be quite a bit of workload on both the provider part and the auditor part, or the MAC part, if you will. But we're waiting to see what changes CMS is planning to make. We hope they're streamlining the attestation a bit, because if you've ever done one, it's quite an intensive document, quite an intensive request for documentation. So again, up to this point, it was all voluntary, and I talked about the benefit. It limits the recoupment. The drawback was, of course, how long it took to submit it and document everything. The other thing that was always required, even if you didn't submit a provider-based attestation before, if you had a new location, that had to be added to PACOS, to your CMS Form 855. That way we knew what the address was. And that's another thing that was really became important around 2015. The address had to be exact. It had to match exactly how you were billing. Otherwise, it would get kicked out. And that was a very frustrating time period for both parties, both groups. But that's always been a requirement, and that will continue to be a requirement. But the big thing here is there's more information to come in a proposed rule there. So let's see, we have a couple questions here. Is a year-end reclass from charity to bad debt sufficient to meet the regulatory requirement? So it actually has to be originally written off as the type that it is. So we've had some questions come up where somebody wrote it off to contractual allowance, and then they've reclassed it or adjusted it to bad debt, and that's not allowable. CMS wants to see the original write-off that was done properly. So that's for that question. Let's see. Why will WPS not include the revised MPI on WPS letterhead, since this is a requirement by Medicare to get a new MPI for hospital outpatient departments? I'm not aware of that. A provider enrollment analyst told me that since we have multiple MPIs, then they must state multiple. We have an MPI for the hospital as well as the outpatient department. Let's see. And then another insurer needs a letter from WPS with the new MPI on the letterhead, and the multiple will not work. So I'm not familiar with any of that at this point. I'll have to get with provider enrollment to see what the issue is there. I'm not involved with the MPI process itself, but let me see what I can find if there's a reason why they're sending a letter, but it's not on WPS letterhead. Is that the deal? Or is it just coming out electronically? And yeah, well, I'll wait for some more. It says multiple on the letterhead. Let's see. Huh. Okay, let me take a look and ask them and see if they can explain why that is. That does seem really weird. Why they're not including all the MPIs. How else are you getting the MPIs? But let me find out from them and see if they have a reason for it, and I'll get back to you there. And see, is it the submission of the attestation or approval of the submitted attestation on the January 1st, 2028 date? It just needs to be submitted. Yeah, hospitals submit initial attestations, but you do also have to obtain the MPI at that point. So that part has to be approved, but the attestation itself doesn't necessarily have to be approved. What the big thing we're waiting to hear back is how CMS is going to streamline that process, because right now the MAC has a certain amount of time to review that bulk of documentation, and then it gets sent on to CMS and they have a certain amount of time to review it. We just make a recommendation to them and they issue the final approval. So yeah, if they were to require it to be approved, that would back that date up quite a bit. And again, the legislation just talks about them submitting the attestation at this point. So more to come on that, but it should be the submission. And again, whenever they issue this proposed rule, there should be quite a bit more information at that time. Let's see, if the provider-based off-campus location is paid under the CAW, does this change the attestation requirement at all? So if they would have, well, yeah, because if they would have billed freestanding, they would have been paid fee schedule. And now that they're under the CAW, they get reasonable cost reimbursement. So it's not OPPS anymore, but it would be cost-based reimbursement. So this, depending on how CMS comes out with this proposed rule, they may be able to exclude CAWs. But again, since there's a payment difference, I suspect they probably wouldn't want to. It would change what happens if there was a failure, because it's not a claim issue, it's a cost report issue. But I suspect that will need to be included as well, even the CAW, because there's quite a bit of risk there. That's right, the reason I say that. And another question, will a field be added in PACOS for the new NPI number for the hospital outpatient department location? And that's a good question. PACOS, I know, is a system they don't update all that often, but when I get with provider enrollment about the other question, I can ask them if they are aware of anything yet. It might be that they don't even know about it yet, if it's something that's in the works for a PACOS update. So, and is the activity on a multi-campus hospital considered on campus or off campus for attestation purposes? So, if it's a multi-campus hospital, then both, what would happen, each of those campuses, you'd be looking at the distance, and that's the other thing I don't think I included. Oh, here I include it. Let me talk about this first for a second. Off campus is more than 250 yards from the campus, but it has to be less than 35 miles. And that yardage measurement is coming from the closest corners of the hospital building compared to the outpatient department. So as long as your unit is, when you're saying it's on a multi-campus hospital, so at that point it would be considered on campus. If those were one of the main campuses, or one of the main campuses, then it would be considered on campus. But if it was more than 250 yards away from the closest campus, basically, then it would be considered off campus. So good question there. Okay, and I'm going to continue on just briefly. We're about the halfway point, actually right at the halfway point slide-wise, but I do want to talk a little bit about these provider-based attestation requirements. Not going into great detail yet. When this all comes out in the public, in the rule, we will put together a video going into much more detail on this, but I want to bring up the attestation as an example, and I want to just talk about these different types of integration. So the first thing is the licensure integration. The clinic, or whatever department we're talking about, has to operate under the same license as the main provider, unless there's a clear state requirement that it be on its own license. The clinic or the department, they're in the trial balance, they're in the general ledger and the accounting system of the main provider. And of course, they're going to be on the main provider's cost report. I mean, that's one of the benefits of provider-based. So we would need to see proof of that. And for that reason, you'd be able to show us the section of the overall hospital trial balance with one or more of the clinics kind of highlighted, or one of the more of the accounts for the clinics highlighted, so we can tell that, yes, it's within the main system. Public awareness is actually a pretty important one, and it's based on signage. If a patient was walking up to your facility, or if they were looking at an advertisement for your facility or your website, is it clear that you are part of this overall hospital chain, or this hospital itself, as opposed to being a freestanding facility? Because again, if they're not aware of it and they don't become aware of it, they may not be aware that they're going to be getting two bills. They'll be surprised by a hospital bill when they didn't realize they had anything to do with the hospital. So that's public awareness. Clinical services, there are quite a few things for clinical services. The big thing is that professional staff at the clinic have clinical privileges at the hospital as well. They have shared clinical privileges. The hospital has the same monitoring and oversight for all departments. The clinical medical director has the same reporting relationship to all the different departments, including the main hospital. When we get into quality assurance utilization review, there's integration there, integration of medical records, and integration of inpatient and outpatient services. So an inpatient at this hospital might go to this other facility for outpatient, or they might be referred back to the hospital for the inpatient services. So there's sharing of those services. Let's see, and then for the outpatient departments, which again, this is what we're going to be talking about, they have additional requirements. They must comply with the anti-dumping rules, the EMTALA, all the emergency requirements that they stabilize the patient, basically. The physician services must be billed properly, and that's a separate issue altogether. Any clinic, and this is just a logical one, any clinic within the hospital must comply with all terms of the hospital's provider agreement. Obviously, they're rolled up under it now, so they have to. All physicians must comply with anti-discrimination provisions. They must treat all Medicare patients for billing purposes as hospital outpatients. Of course, if they're inpatients, it wouldn't be part of this clinic. Obviously, it wouldn't be part of the outpatient department. Then there are some health and safety rules, some other basic things. So we have on our website, we have a few articles right now, and we'll be adding to this as we get more information on it. The big one is just the provider-based attestation link. Then we have general guidance on that attestation. Then we have one just going into more detail about the financial integration and the shared space. So all of that information is there. And I just briefly wanted to bring up the provider-based attestation. This different MACs might have a slightly different version, just basically the contact information, their letterhead, all of that. They might have some different initial steps, but the actual steps have been developed by CMS. They've been, I guess, streamlined by CMS for what needs to be submitted. And it's actually when you get down here, all of these are just notes. This one talks about how, again, if there's no payment difference, it might be in the future. They might be doing this ahead of time, or they might be in the past, and they decided to start doing it. We need to know if it's an initial attestation or a subsequent one. What type of provider-based unit is it? What services do they provide? And what is the payment difference? An explanation of how they'd be paid as freestanding versus provider-based. That determines whether or not we can even go any further with this. If there was not a payment difference, there would be no need to go further. Then we talk about on-campus or off-campus because that drives the rest of the attestation. Off-campus has additional requirements. And then again, on-campus or off-campus. And then we start dealing with the actual items of integration. Well, first of all, where are you located? Are you within 250 yards? That would mean you're on campus. Are you more than that, but less than 35? That would be off campus. And we talk about the distinction between the other healthcare space. So it has to be very clear that this section of the hospital is this particular unit. So there has to be just a clear identification of what unit you're in at that time. 35-mile radius, all of that. If there's a multi-state situation there, we have to have proof for that. And some other exemptions for location. So we'll talk about quite a few of those, or there are quite a few of those available. Then we get the licensure, and I already briefly talked about that, but it goes through all the things that need to be in the documentation. This attestation has been built up over the years as we've dealt with virtually all of the CMS regional offices, just because we have providers in almost every state to some extent. So we've dealt with every single regional office, and that's what has led to this attestation. We all MACs got together and worked with CMS several years ago and created a standard attestation covering all these different things. So then we get clinical services integration, a lot of the things I just talked about. I'm just kind of showing you where they are without spending too much time on this. Financial integration, the trial balance, making sure that's been integrated with all the different facility types. Public awareness. So we need pictures of provider-based signage, both inside and outside. So that answers one of the questions we have over here. That needs to be inside and outside. It needs to be very clear that it's a part of this hospital. And then all of the different things related to outpatient. So again, we could easily take up an hour or more talking about this. And when we do a video, it likely will be about that long. We'll talk about some of the examples we might see, all of that. But down here, it just by the way it's set up, it has a step, and you put your initials or yes, no, and then down here you have to label it as an exhibit. So here's what you submit to document 5E, for example. It'll give you an example of what to include for that. Some joint venture stuff, that's your provider-based issue. Ownership and control. Administration and supervision. Management contracts. So you can see it's a 21-page document, which again has become less and less common up until now. But now the big concern is with all these different units that are going to need to be filing these, we really hope CMS streamlines this and figures out what steps do they really consider critical, and maybe the other steps are optional for that point. But again, that's purely coming from me. We have to wait and see what CMS says. And of course, it has to be signed and submitted. So a lot of information on it. Let's see what other questions we have here. Talk to the on-campus, off-campus. If a claim has professional fees, we have to deduct the professional fees as total charges for claim 1,000 and professional fees 1,000. The write-off amount has to be 0. Are we talking about bad debts now? Yeah, in that case, yeah, the bad debt would be 0. If the professional fees are just part of the total charges, then you're correct. It would be 90%. As long as you could tell. So that's assuming the entire claim was kind of charity care, as opposed to just part of the claim being charity care. If only part of the claim is charity care, then we might have to figure out, well, do you know which exact services were approved or what? It might be a pro rata split like that, or it may not be, depending on the specific situation. But generally, it would be in that case. And let's see, if the off-campus provider-based location is in existence today and built under the hospital MPI, yes, a new attestation and a new MPI will be required by that 21 or 28 due date. Correct. Yep. Any old attestation, it can't carry over. Now, that being said, a lot of the documentation is still very valid. So if you've already done one, you'll have an easier time resubmitting it because a lot of it's still going to be the same. So I would definitely use that as a starting point, but make sure if something has changed that it's updated. So, yep, good question. And definitely a new MPI. So that's what we had for provider base. Again, a lot more to come in the near future. Well, hopefully the near future. The time is ticking already. 1/1/28. It's still a year and a half away, but that time goes by quickly. So let's go into a new topic with organ acquisition counts and revenue offsets. So I know this is a topic that doesn't impact every provider. It's a relatively small group of providers that tend to be big hospitals just by their nature. So we have a few things when we're looking at organ acquisition that CMS requires we look at. And for the organ count, so to give a kind of an overview here, in determining how much cost reimbursement a provider gets for their organ acquisition, kind of the last step is taking all the costs for organ acquisition in general that were approved and multiplying it by a Medicare organ count. So it's basically Medicare organs divided by total organs, although they're kind of backwards in the order of the cost report for whatever reason. But in any case, we need to know the total organs And then out of those, we need to know how many were for Medicare beneficiaries. But there are a few rules that have changed over the years regarding how to count this. So for total organs, if you look at the cost reporting instructions, it is total organs that are excised or purchased minus unusable organs that couldn't be transplanted minus research organs after 1/1/23, regardless of whether they were intended for research initially or not. That was a change that was made at that time. That was a clarification. And I believe that was in the Federal Register when they came out with that. So that's the total organ. That's basically the denominator of the fraction. And then we have Medicare organs on line 63. It basically says, we start with total organs, but only those that were for Medicare beneficiaries. We cannot use organs used for research. Those have to be subtracted. If the organ was sent or sold outside of the U.S., that has to be subtracted. If they're transplanted into non-Medicare beneficiaries, of course, if the provider is aware of that, then that can't be included. If the organ was totally paid by primary insurance other than Medicare, in other words, if Medicare didn't pay any portion of the transplant, then they're not going to pay any portion of the acquisition either. And then if the organ is paid by a Medicare Advantage plan or an HMO plan, that's not allowed, with very limited exception here. Kidneys transplanted into Medicare Advantage beneficiaries on or after 1/1/21. So that's kidneys specifically. I know that's odd. Most of the organ acquisition rules are across all the organs. For that one, they limited it to kidneys. And then organs procured from a non-certified OPO. Now, just really quickly, one of the changes CMS was initially planning to implement required providers to track if they sold an organ to an OPO and then it ultimately went to some beneficiary in another hospital. They were going to be required to track the disposition of that ultimate organ. Did it indeed get transplanted into a non-Medicare beneficiary or not? That was left out of the final rule. They decided against that. So if it goes to an OPO, a certified OPO, then it's counted as a sold organ at that time. It's counted as acquired, and you'll get the cost for it, but you'll offset it with the revenue that you received from the OPO. Again, assuming it's a certified OPO. So we have our organ counting issue. A couple of additional odd issues that come up. We have these on our website as well, but there's one called en bloc, and you can find the definition of that in the new policies. CMS did a pretty good job of cleaning up the policy at 15.1, section 3115, and it basically says that if you have two organs of the same type that are transplanted as one unit, this is considered one organ. So, for example, en bloc kidneys, where two kidneys are taking the place of one kidney, two lungs are taking the place of one lung. Now, it sounds odd that that can happen. It quite often happens when there's a pediatric donor with obviously smaller organs that would not, each individual organ by nature wouldn't be large enough to transplant into an adult. Now, of course, whenever there's a donation, an organ donor, the matching is what's important. Who's the closest nearby recipient that's on the list, and they're going to get it. Now, it would make a lot more sense logistically if it was another pediatric recipient, but as you can imagine, that's probably less common. And again, the timing might just not be right, the timing and location. So pediatric organs sometimes are transplanted into adults, but it might take two kidneys to serve as one adult kidney. And that's what this en bloc is all about. So CMS clarified that this one organ counting only applies when they're the same thing. The definition of en bloc also includes something separate where there's two organs that are transplanted together, even though they're different, like a heart and a lung. Sometimes they're transplanted as a pair because they generally work better if it's the same donor that had both the heart and the lung. Obviously, a deceased donor in that situation, well, virtually all the times a deceased donor. There are some weird situations that happen that could cause that domino transplants. But in any case, the heart-lung pairs, the kidney-pancreas pairs, those would be two organs. Even though they're transplanted at one time, one group, they are still distinctly two separate organs. So en bloc is an unusual one when it comes up, but it's a rule CMS has really stressed over the years. And then we have another thing that's really not truly an organ to begin with. It's acting as an organ, but it's not really an organ. It's a total artificial heart or a ventricular assist device. Certainly very good technology that is very helpful when there is no donor that matches you at that time. But because these are not organ acquisition type things, you're not excising an organ, it's technology that you have, they're never going to be counted as a Medicare or total organ. Instead, the device cost itself, so the actual thing that's going to be implanted, is worksheet A, line 72. And all the other costs related to the surgery to implant it, that's going to be in your standard routine and ancillary cost centers, just like any other surgery. But again, that matches up with the transplant DRG. That would never be related to acquisition to begin with. So if you see one of these two things, it's never going to be considered as organ acquisition. Now moving on to the revenue offset issues. So we talked about cost. I said very briefly, if you look at the top of D-4, and there are a couple of other parts of D-4 that are building up to this point to get you to the total allowable cost for that particular type of organ. Then that's multiplied by the Medicare organ ratio, which again, I said we basically take line 63 divided by line 62 to get that ratio of Medicare organs. Whatever your cost is multiplied by the Medicare organ ratio is the allowable cost. However, that needs to be offset by any other revenue that relates to these organs, whether it be revenue that was received from the sale of organs. So you had all these acquisition costs, excising organs from a cadaver generally, maybe a live donor. But then if they were sold to another OPO or an OPO to begin with, whatever revenue came back, of course, is used to recover the cost of the acquisition. So that's an offset. And then there might be partial primary payer payments that offset it as well. But keep in mind, the key word there is partial. If the primary payer paid everything, we shouldn't see the organ on here, and we shouldn't see the offset of the revenue either. So this is only a partial payment by a primary payer. Now, they have a part for the acquisition to offset that, but if there are any primary payer payments for the transplant, that's just informational. It does not offset what's allowed for acquisition, because remember, those are paid on DRG. They're not even part of the acquisition issue. So we're not going to offset transplant payments against the acquisition. They have to be separated. So there was a change here in what that revenue is going to look like, where it comes from, where the billing comes from. For example, when you're billing the OPO. Before 2/25 of 2022, which by the way, that was before the implementation of the federal fiscal year 2022 IPPS final rule, and this particular date was an odd one. You know, normally the final rule becomes effective 10/1. This one had a weird date for it. So 2/25 is the cutoff point. Prior to that, the hospital had to bill the OPO the lower of either the standard acquisition charge, the SAC, or whatever customary charges they normally calculated after reducing them to cost through a cost charge ratio. So whatever was lower had to be billed, and that would show up as our revenue. We would require that to be offset as a revenue offset. So if this was audited, and we saw that you had X number of organs sold to the OPO, we would be requesting documentation to prove that you did indeed bill them one of these two items, and that's the amount being used to offset right now. Of course, CMS's concern here is that the revenue offset is too low, that it's missing something, because that overstates reimbursement. So that's the kind of the aim of CMS's reviews through the MAC, through us, of course. On or after 225.22, it changed just slightly. They now must bill a lower of the negotiated rate or the customary charges. So it's not that standard acquisition charge anymore. It's a negotiated rate. But there's a general rule that applies to both of these. Whatever you offset can't be less than the amount actually received. For example, if you billed some amount and for some reason the OPO paid a higher amount, that amount received has to be offset, has to be fully offset. So we have that, and that is, again, that's our issue for organ acquisition. I know it doesn't apply to everybody, just wanted to stick that in there. And we'll have more when the when we get some additional, we expect some additional guidance on how to review some of that revenue organ offset. So we'll try to provide more information on our website once everything is finalized. So the next thing, this is not a new topic, but it's still been coming up. It's the RHC vaccines. If you look at worksheet M-4, foreign RHC, this in part helps to determine the cost reimbursement that an RHC would get for providing a vaccine to their patient. From the hospital, or if it was before they went into the hospital, that's perfectly fine, but they can't be simultaneous patients of both the hospital and RHC. If they are, that gets rolled up under the hospital DRG. The RHC won't get any extra cost reimbursement for that vaccine. So what it boils down to is we have 11, which is your total injections or infusions, and then number 13, line 13 is program, which in this case would be Medicare. Now across M-4, we have all the different types of vaccines, and then we have a total at the end. So every one of those is going to have its own count and cost and everything. By the way, I do want to point out one thing before we go any further. Line 13.01 is specifically for COVID-19 vaccine injections administered to MA and so this term right here, program beneficiaries. Program is Medicare, Part A, Title 18, or I should just say Medicare Title 18, actually. That's the program beneficiary. So the question that comes up quite a bit is, does a Medicare Part C, the Advantage, does that get rolled up under Part A, or is it paid through the insurance company, the MA insurance company? And that's different on different things throughout the cost report. It's kind of a weird situation. Medicare steps in to pay for certain things, but then they say, no, this other thing has to be through your insurance company. For example, Medicare Advantage bad debts cannot be allowed on the Medicare cost report. So that's what we have here. So unless the instructions explicitly require Medicare Advantage to be included in program beneficiaries, they are not. By default, they are not. Let's put it that way. Now, line 13.01 specifically says for COVID-19 injections between 20 and 21, we will bring in the MA enrollees under this definition, but it's a very limited definition. So that implies that MA should not be in any other line or column because there's no other line or column with that type of instruction. If by default they were to be included, there would be absolutely no reason for line 13.01 to be there. That's only needed because it's a non-standard treatment. And if we go down here and look at the M-4 instructions, there's actually, it's starting in the first paragraph, it says, additionally, only use this worksheet for vaccines rendered to patients who, at the time of receiving the vaccine, were not inpatients or outpatients of the hospital. If they simultaneously received vaccines with any other Medicare covered service as an inpatient or outpatient of the hospital, the vaccines are reimbursed through the hospital and cannot be claimed by the RHC. So it's extremely clear that that is the rule. And then it also says, hey, there was some legislation that brought in MA enrollees allowed for that COVID-19 treatment for those 2 years. So sometimes the introductions to the instructions can give you some good information there, as well as the lines themselves. Now on to the requirement for documentation. This has changed as well. For total vaccines, the only thing we're going to see is a log, and that's all that exists, and then whatever supporting documentation is behind the log. Again, that's your own records. That's some non-Medicare beneficiaries. For the Medicare vaccines, which of course are a subset of the total, the big question is, what documentation do we need? Is it provider records? Is it PSNR? So if the log that's submitted for Medicare vaccines, it now effective 7/1/25, it has to be billed to as a claim. So it has to be on the PSNR. So effective 7/1/25, and this is service dates, by the way. Or no, I'm sorry. That is cost report periods beginning on or after 7/1/25. Actually, you know what? Think about that. No, that's not right. That rule is for cost report periods beginning. However, so here it talks about if they straddle July 1st, 21/25 or 2025, that's the break off point. So it is service dates for this required for the PSNR. It's the service date that matters there. Regardless of what your cost reporting period is, if your service date was on or after 7/1/25, that has to be billed and it has to be found on the PSNR to be allowed. We can't take just provider records for that anymore. And CMS I don't know if they've already done that actually, or if they're working on it. They're working on clarifying that even further in the policy, because right now it was left a little bit ambiguous. Almost you could do this, or maybe you should even, but it's going to be clarified to be a must. That's what it was always intended, and that's what they want to stress there. So that information will be there soon, but they are requiring us to follow that must right away. Talked about that. We talked about the billing for that. So now we'll move on to the next topic here. This is a fairly brief one. It's one that seems to come up all the time now. It's the low volume and MDH extensions. So these seem to constantly, and it's been this way for a decade now, where they expire. Legislation expires. Let me back up a second. Low volume and MDH both, when they first came out, when MDH first came out, and then when low volume was first expanded, they were both set up as temporary provisions. They've never technically been permanent. They've always been temporary, but they've been continually extended over the decades. And that's how we still have it today. They're still not permanent. So we have to look every time one piece of legislation expires that extended these, and they always go in pairs. They do it in this pair. So we need to see, is there new legislation taking its place that'll extend it? The big problem is, especially this past year or so, it's that the expiration happened, and then there was not an extension until months later. So low volume and MDH, for example, expired on 9/30/2025. Now notice that was right at the end of the federal fiscal year anyways. So if nothing else, it was a nice clean cut. But then it was extended retroactively to 1/30/26. So that means any claim from 10/1/25 to 1/30/26, when it first processed, it would not have had the low volume or MDH in it, but we had to reprocess them. Now so after 1/30, it expired again, but then Congress passed a new extension all the way to 12/31/26, the end of the calendar year, which is kind of a clunky way to do it. Because again, as we're going to see in another slide, low volume at least, is based on a federal fiscal year. We recalculated every 9/30 or every 10/1, I guess. So the fact that they extended it to 12/31, that just kind of means it's straddling another federal fiscal year. So all the claims reprocessing has been done for all of these all the way back to 10/1/25. That was actually done as of 5/29. But what I want to stress with that is that after our claims area reprocesses them, they still have to wait on the 14-day payment floor. That's the phrase for it, which I believe the whole purpose of that is to allow for medical review, allow for that extra level of auditing on the claim side. So there's that 14-day payment floor. And then at that point, it's actually paid. It's on the PSNR, all of that. So, for example, when I say it was done as of 5/29, you would not have necessarily seen all your payments by 5/29. You would have seen them by what, 6/13, something like that, 6/12 maybe, whatever the 14-day payment floor was. But again, that's almost 2 weeks ago. So if you don't see any that have been reprocessed, let me know, send me an email, and we can look into it. We can order a PSNR and see what might have happened. Again, the low volume payments, they're fiscal year based, 10/1 through 9/30. And the couple important things to note about that, every year requires a new attestation. So another one of those frustrating things that we have to do every year, even though you the mileage is what has to be attested to. We grab the discharges no matter what. We have the documentation for the discharges from the cost report, but you have to attest that the mileage hasn't changed. In other words, no new hospital has popped up in between you and the other most recent hospital, or the roads haven't changed to make the mileage shorter, anything like that. That mileage attestation is generally due by September 1st annually. And the problem with it is it comes out in the Federal Register that's usually mid-September or mid-August. That's usually when the Federal Register pops out. So it's one of those things. I start ahead of time for WPS. I start sending out reminders to any emails we had from last year. I start sending out reminders ahead of time for anybody that hasn't submitted it yet, if they still qualify, if they're still under the discharge limit. And I just keep following up until the end to try to make sure you have the ability that you're aware of it, because it's such a tight time frame. So definitely email is preferred for those submissions for that very reason. Then next year I can use that email as another reminder. But the couple things I wanted to mention here is that once you submit the attestation, let's say you submit it on 8/15, we're going to use the most recently submitted cost report as of that date to grab your discharges to calculate your low volume payment. Even if you have a newer cost report come in later, we won't be using that for that year. It's locked in. So just keep that in mind when you submit it. If you're aware that you have another cost report, let's say you're on August 1st, let's say, and you're thinking about submitting it, but you know you're going to be submitting a new cost report 2 weeks from now, you might want to take a look at which of those cost reports would you rather use. You may end up wanting to delay your request until after you've submitted the 8/15 one, for example. Just make sure you're not late, because being late adds in a 30-day gap where you won't get any low volume payments, a minimum of a 30-day gap. Let me put it that way. It's 30 days from the day we calculate your new MDH payment. When those happen, I try to get them done extremely quickly, but again, you don't want any gap at all. So make sure to hit the 9/1 time frame. Let's see. The same payment rate is used. Once that cost report is locked in, we calculate the payment rate based on the number of discharges, and that carries throughout the entire federal fiscal year. Even if there was a break, like there was a termination and then an extension, it doesn't matter. We're not going to calculate a brand new rate. We'll use that same one and carry it all the way through the rest of the federal fiscal year. I guess one other thing I don't have on here is that it's kind of an odd thing. I'm surprised CMS hasn't changed this yet, but it doesn't matter if you have a short or a long cost reporting period that's being used for this. It's not prorated. It's not annualized. Whatever discharges you have, high or low, that's what's used to calculate your rate. Sometimes that'll help a provider. Sometimes that'll hurt a provider. But again, that is currently the rule from CMS, that there is no annualization or proration done. but again, it's kind of odd, but they would have to put it through the proposed rule process to get that changed. So once we do get the attestations and we do all of our work, all of our review work and documentation, we send the letters out in bulk. So as long as you get the confirmation from me that I've received it, that's good indication that you're going to qualify. Again, assuming that your discharges were below the threshold there. Let's see. Let me look at the questions we have. I have that one. How do we determine if the OPO is certified? Yeah, I don't have any information on me about the listings of the certifications. That would be something, I mean, you could ask the OPO for proof of their certification. That might be something where a simple Google search might help you to find that. But I'm not aware of any approval listing for the OPO itself. For the CTCs, we definitely have the approval listings from CMS, but I'm not aware of an OPO approval listing. There's probably one out there. I'm just not aware of the location of it. So that might be something I'll look into. I know actually, just a note, I meant to say this before we were done with the organ acquisition. My next training project internally for auditors is the organ acquisition section. We have modular training. And as soon as I'm done with that, I'm going to be rolling some of that stuff over to the provider facing side and expanding what we have on the website. I started a little bit of that, I think last year or maybe even the year before. We put a little bit out there, but we didn't have everything done internally, and there have been some changes in this past year. So that's one thing I'll try to put into that training, both internal and external, about the OPO certification. Let's see. For the federal fiscal year ending 5/31/26, for the RHC vaccines, we'd have our log for June of 2025, and then the PSNR, yes, the PSNR for the rest of the fiscal year. You're exactly right. So there would be a split situation there in what documentation is needed. What report type on the PSNR? So I have that in documentation. I don't have that on the top of my head, though, but I know I have it in some documentation. I'll have to find that unless someone else is aware of the report that's on here. But I'll find that, and I might try to stick that in the slides before I send those out. That might be the way I can document it most easily. And let's see, yeah, Kirk, and that's exactly what I was saying earlier. Even though the Medlearns matter, the way they wrote it, it kind of uses softer verbiage. CMS is actually requiring it. They're mandating it. They're making it clear there. So they're going to be updating some of that to make that extremely clear. But it's not an optional type thing. Thanks, Scott. It's report 71S. So it's unfortunate, but yeah, they are mandating that. They built that system. They built that in place. They want to use it. And what if a new hospital is scheduled to open up in March 27, negating the mileage criteria? So if you're low volume, I see. So if you've already, let's say 10/1/26, you've applied, and at that time you meet the mileage criterion, but then in March of the next year, before your fiscal year is up, a new hospital is located. So the fact that they're planning to open up doesn't prevent you from getting it right now. Now, I know with Soul Community Hospital, if there's a mileage change, that would terminate the status then. But for low volume, there's really not a provision, and I think maybe it's because it's done every year. You're attesting to it every year anyways. But that's a really good question. I think I'm going to bring that to CMS's attention to see what their thoughts are. There's nothing, here's the biggest problem. After you've attested to it, there's no mechanism certainly no mechanism for us to come in mid-year and audit it, say, well, hey, is there something new now? And there's no similar mechanism like there is for the SCH that mandates self-disclosure. So that doesn't prevent somebody from self-disclosing, but with SCH, they built in a mandatory self-disclosure. And if you fail to do that, you could lose your SCH status retroactively back to that date. But there's nothing like that built in for the low volume, but it's a very good question. So I'm going to bring that up to CMS and see what their thoughts are, see if we should treat that kind of like the SCH, or if that would just mean that the next time around, you can no longer make that attestation, and therefore you're done in the second year, but not part of this first year. So it's a really good question. I can see both ways, but in a way, I kind of think that since there's no vehicle built in, I kind of think they're going to do it on a year-by-year basis instead of midway through the year. But I don't know how long it'll take to get anything back, but I will certainly put out a request for that. And, we might be able to get it back by the time, we probably will. We'll probably be able to get it back by sometime in August. It seems like a quick response. The question is it something they've even thought of? And if not, then they're going to have to work throughout their policy area to figure out how they want to handle it. But I'll put something out in our website around that time with whatever we have at that point. So very good question. Thank you very much for that one. Let's see. Regarding audits, specifically desk review audits, should we be continuing to expect questions and requests from auditors for data for closed NPR and Medicare cost reports? So the only time that might happen is if we were doing like a reopening. Of course, it was closed, but then we're doing a reopening to look at something. Sometimes that happens if there's a quality review, like if CMS is doing a quality review on us and they request more documentation for something. A lot of times they might just say, hey, you really should have got this documentation, so we need you to get that now. So we would request it at that point. It shouldn't happen all that often, but it definitely does happen, and that could lead to a reopening at that point if it's a quality review. Of course, if it's within 3 years, absent any evidence of fraud, that's a whole different animal there. But so I'd say that still could be the possibility. That's always been the possibility, and it certainly could be in the future, mostly through to the CMS quality reviews or other CMS initiatives in general. Okay, so now moving on to a topic that's, I said low volume was pretty quick, took longer than I expected, but this one I really need to hit at. It's just a little piece of this change request 13413. It relates to our SSI realignments for the older cost reports prior to 10/1/2013 fiscal year begins. I have the link here to it. The time frame for those was 24 months from the receipt of each provider's SSI realignment request, unless it's one of those issues that needs to go to CMS, and then the time frame is 24 months from that date. That being said, we're starting to get some of the SSI ratios back from CMS. We have a lot of these we've been waiting on. We've already done as much work as we can. We certainly have no intention to take this extra 24 months after the date we get it. Most of those are getting ready to go. Once we get that ratio, we plug it in, it gets to our secondary review queue. So we're trying to get these out as quickly as possible. We don't want to sit around with this project forever by any means. I'd like to get that off of my desk and off of everybody else's desk. Now, that being said, when I say off the desk, there's really no end date to this project, because there could be someone 5 years from now could submit a brand new SSI realignment for these old years, and assuming it meets all the requirements, we'd still process it. There's no time frame for when you have to submit these requests. That's kind of what it boils down to. So there's the due date, 24 months. Now, on to that issue where we had to send it to CMS. There are only 3 scenarios where we have to send them on to CMS. We can't work them right away. And by the way, I mean 3 scenarios other than the normal scenario for the newer SSI realignments later than 10/1/13. Those always have to go on to CMS because there is no published realigned ratio for those. For the older ones, the 10/1/13 and prior, there's a published ratio, and we can use it for the vast majority of the units, but for those 3 scenarios that I'll talk about in a bit, we can't. And what we're finding now is that it's likely to be a different ratio altogether. So let's go through that. Again, this whole change request, all these requirements, all the time frames only apply to fiscal year begins before 10/1/13. For any newer ratio, the standard process is in place, and it's treated very similar to a regular reopening. Not exactly the same, but very similar. Now, the earliest date we could see is 10/1/1987 fiscal year begins, because there were no realignments for the few years prior to that. Between when DISH started and that date, realignments didn't exist. They weren't the regulations. As I just said, there's no time frame for submitting these requests, and I really should call these realignment requests, not reopening requests. There's no 3-year time frame for those. They're a revised settlement. They're not technically a reopening, although 99% of it's the same thing. We do have some information on our website under the CR 13413 link. Keep in mind, this link above it is for the remands that were done March 25th of last year. So those are already done. We've been spending our time on the SSI realignments now, and these take quite a bit more time. There's a lot more calculation to it. So if you do have a request, it needs to be sent into this email address or my individual email address, Chris. To show us what that realigned ratio is. You don't have to provide any other information, just these 3 things. You can certainly include multiples in one email or one letter. But by the way, we prefer email just because we can quickly respond and everybody knows that the information was received. We talked about the due date being 24 months. Now, some of these, especially the really old ones prior to 96, those are the ones that take the most time, because there is no HFS system that currently works to process those. And even if it did, the cost report file, we wouldn't be able to find that anyways. And I shouldn't even say we'd be able to find it. It wouldn't be able to run on a modern Windows system. That's the problem. CMS does not want those electronically. They want them in an Excel-based format that we are creating or we're working with. So we have to find the files and kind of convert it into this Excel-based template, if you will. Once we're ready with the adjustments, we'll send them out for review. But they're generally going out while they're in the secondary review queue. Now, we're trying to shorten the time frame there, so we're not going to send these adjustments out right away. We'll wait until they're closer to the top of the secondary review queue. In a perfect world, you'd get them, you'd be able to review them right around the time the secondary review is done to get the payment out. That's the goal. Sometimes there's more of a delay there than expected, largely just due to the absolute quantity of these that we have, as well as the quantity of multiple other projects and reopenings going on at the same time. They're all CMS mandated projects. So let's see, we talked about that. But here is what I was mentioning earlier. If you look at CR 13413, which you can go Google and find it, it's a public CR. It says, for the following situations, the MAC should hold the new or confirmed realignment request and shall forward the request to CMS with this included in the subject of the email. So the first one is pretty logical. If the cost report begin or end date in the provider's request doesn't match the information in the SSI ratio file from the website, then certainly that makes sense. Now, assuming you have the proper begin and end date that matches STAR or STAR system, and for some reason CMS thought it was a different year, then of course we can't use that ratio. They'll have to recalculate that no matter what. The second one is the one that's perhaps going to be the biggest. It is the biggest for sure. If the provider requests a realignment for a cost reporting period that includes discharges prior to 10104 that is not subject to CMS ruling 1498R. In other words, you didn't appeal that, you weren't part of that group appeal. Therefore, what CMS is telling us, this is, I guess, some new information that I wasn't quite aware of at the time, but their response is that the reason they needed to see them is that since you weren't subject to that appeal, you don't get the benefit of that new base state matching issue that came out of the appeal. The ratios that are posted on the website, the realigned ratios, have the base state matching issue built in. In other words, it's more recent data. CMS is saying we need to recalculate it on the non-base state data, the kind of the older data, if you will. Now, this can either increase or decrease the realigned cost report ratio or realigned SSI ratio. We've even seen situations where it decreases it below the original ratio you were otherwise going to use. Now, obviously, that's not a good situation. You were looking for additional money. You certainly don't want to end up with less money because you requested this. For most realignments, and I stress the word most there, for the standard SSI realignments, the rule has always been that once you request it, you're locked into it. However, CMS, after recent conversation with them, they've made an exception for this particular situation. This whole the pre-10104 and they're not subject to the ruling. If the SSI ratio comes back lower than the other ratio they already had, CMS is allowing us to reach out to the provider to basically see if you'd like to withdraw that request and have it closed instead. Obviously, if you don't, there's going to be a negative settlement, and I'm sure you wouldn't want that. So that's the somewhat new bit of information we got from them. I guess it could have been implied from the CR. I just didn't quite read into it that much. And again, that option only exists for those special SSI realignments. You can't use that for the new after 10.113 realignments. You have to do your own due diligence up front to determine whether you think the realigned ratio is higher or not. And at that point, you're taking the risk that if it is lower, you're stuck with it. But for these older ones, we have the option to pull it back. So let's see here. Worksheet S-12, we have some additional miscellaneous issues here. And this, again, this is one of those things I wanted to bring up, but it's not like I have any special information at this point. We don't. Max do not have any information on this yet. We're basically at the same level of as you are. We can see the cost report worksheet instructions, and at this point, that's about it. We expect more to come out on this soon, but really this is the exact same thing as worksheet S10 was when it first came out for charity care. The review protocol didn't come in until years later. Keep in mind, that was 10.113 when that rule first came into play. We didn't start auditing that until later. So S12, we expect to be the same thing. They're wanting the documentation, or they're wanting the reporting. There's not a template at this point of how you need to support that information, how you need to show the average, for example, and I'll get to that in just a bit. And again, there's no review protocol that CMS has told Max about yet. I suspect it'll be there at some point, in the next year or two. This new worksheet is for fiscal year ends on or after 1/1/26. So if there happen to be any 131 providers out there that are filing their cost report this month, they would be the first ones impacted by S12. Again, it's unfortunate we don't have much more at this point, but that's kind of where we are. What this S12 is all about is the goal is for CMS to take a look. Right now, the MSDRG relative weights that help to determine how to allocate the payment across the different DRGs, it's currently based on cost from the cost report. They're trying to get this to more of a kind of a market-based approach. And to do that, the best way to do it with Medicare data is to look at Medicare Advantage organizations, because they're kind of Medicare, but they're also working with insurance companies and they have negotiated charges. So it's kind of a subset of the full healthcare market, and it's one that CMS can reasonably access. So what they're looking for you to fill out on worksheet S-12, which, by the way, let me just, well, I guess I have a screenshot on the next slide. They're looking for a weighted median. It's not an average. It's not a mean. It's a median. So it's the middle value of payer-specific, in this case, insurance company-specific negotiated charges for each DRG. This is what S-12 looks like. It has every single possible DRG with its explanation, and it wants that median charge to be reported here. Now, as far as calculating it, the way the instructions do a decent job of kind of showing you what they're looking for, but as far as a template, there isn't one yet for how you support your calculation. So what they want is for, let's say for DRG1, take a look at how many discharges you have across all of your MA plans, all the patients that were MA patients, find what that negotiated charge was, list them out, highest to lowest, and find the middle value, the median. Again, it's not an average, it's not a mean, it's the median value. So if there were 21 units, you'd go down to that absolute middle of the list. So that'd be, I guess your 10th one would be right in the middle, or your 11th one. Your 11th one would be right in the middle of that 21 unit listing. Now, if it's an even number of items in your list, at that point, they say find the two middle charges and average those two. That becomes your mean for this situation. If you use Excel, you can actually grab a range of data and search for the mean of it. There are different functions you can use or different formulas, or you can do it any way you want there. But that's what they're going to be requesting here. Now, when the template comes out, it might be something like every DRG has a tab, and then you put in the list of charges and prove that mean calculation. I'm just guessing there. I don't really know how much detail they're going to want to see and how much detail they're going to have us review. So there's a lot more to come on this. And so we have a couple of other questions before we wrap things up. Is there a reason that WPS will not email the demand letter? Other MACs will email the demand letter. So are you talking about the NPR letter or the demand letter that comes from reimbursement? That might be the one you're talking about. So I know for our NPR letters, outside of the remands, for the remands last year, just due to the absolute sheer volume of them, we had a special process in place with our mailroom. But for the SSI realignments and for all other reopenings, we have a kind of a two-stage process. We have what we call the paperless process, which is an email. That's only if we have an approved email for that provider. If nobody responds to us, then we don't have an approved email, then it does go the manual approach. But if you're talking about the demand letter from reimbursement, that's something I'd have to get with them on. I'm not sure if there's a reason they might not send that out. And let's see, we have outlier payments for this. That I'm not sure about either. There's no information in here. I suspect no, because they're wanting just the negotiated charge. So I suspect that would not include any sort of outlier payment, because that would be outside of the standard charge. And let's see, how about the use of machine readable file and completion of the S-12? Yeah, I did read through that. I see that verbiage, but I don't really know what CMS is expecting with that. And I see there's a message about probably just the size of the files that'll crash the file transfer. That could very well be. And that's something, whenever CMS starts to get MACs involved in this process, which they usually do before they start issuing the like the template or the review instructions, they'll get us involved to some extent. So those are some things we could bring up there. But for right now, all you need to submit is this basically just this S-12. We're not doing any sort of review protocol yet, so we don't need to see a template at this point. And yeah, that should include, I believe, all of the different units that might have these DRGs. So that would be any subunits. Report type 118, so that'd be your Medicare Advantage anyways. That would probably tell you what your DRGs were, so that'd be a good starting point. But that assumes that that partly is dependent upon what type of provider you are, how you build it. Do you have GME, nursing, allied health, all of that? Some of that determines whether it's even going to make it to report type 118. So you might have some Medicare Advantage claims out there that don't make it to report type 118 because your provider type doesn't need them. So for that reason, you can't blindly rely on 118 as your starting point until and unless CMS makes a change down the road to how that's all billed. But it's a good question there. And so I see the question there. So as long as those DRGs, as long as all of your Advantage DRGs make it to 118, then you're exactly right. That would work perfectly fine. But if you have, again, if depending on your provider type, if some of your claims don't make it to 118, they're not shadow billed, for example, or no pay billed. If they're not billed for one reason or another and don't make it to 118, then you'd obviously be missing some claims. So that's just dependent upon your specific situation there. And down the road, again, whenever we bring this up to CMS or whenever they bring it up to us and invite us to a meeting, those are some of the things we'll talk to them about. And let's see, we'll move on to the last couple slides here. Just a quick note about the website. There's our link in our YouTube playlist, which is where we put all the webinar recordings. And now this time, so I put out a schedule last time in our February webinar. I'll try to stick to this better. It's always going to be a Tuesday, Wednesday combo. It'll be Tuesday at 1, Wednesday at 10. That seems to work best for most parties. And I'm going to try to stick to these dates. I know that's not quite 3 months away now. It'll be about 2.5 months away due to this month's delay, but I'll try to stick to those so we're not getting too far into September because I know that gets to be a crunch time anyways for people. And then early February, or early December seems to be the only time that works for a large number of people. December, just as soon as you get closer, as soon as you get past the beginning of it, all sorts of events and stuff are happening for obvious reasons. So we'll try to stay right at the beginning of December. So with that, I know we're a few minutes over. I just wanted to see if there are any follow-up questions or final questions before we wrap up. I'll kind of keep an eye on the chat here. And just wanted to say thank you for your and make sure you get your certification for the CET, CPE. So sounds good. Well, thank you for your time today and have a great week, everybody.